people have different situations, and maybe that's not the best choice for them, right? In our business as a mortgage broker, we are the Canadian Tire of the mortgage industry, okay? We work with 115 institutional lenders, and I looked this morning on our system, and that constitutes about 4,800 different actual mortgages, okay? So, you know, I like to, I'm gonna use my little pointer here. You know, we have this little saying here, we have a mortgage for that. And we really, truly do. I mean, I've even gotten mortgages for people that don't have jobs. Okay, so I mean, we have so many different lenders, so many different programs that, you know, we can basically get you approved, okay? So let's walk through getting approved for a mortgage and what that entails, okay? So there's 3 basic questions that a lender is asking themselves when they're thinking about giving you a mortgage and lending you some money. And, you know, the first question is, can you pay me back? Okay. So that really comes down to your employment or income history. They want to look at your history of earning and, you know, whether your earnings are consistent and whether or not they're going to continue on. They're going to look at your debts and they're going to compare your income versus your debts. And we'll go through the math and the calculations in a second, okay? The other question that they want to know is, will you pay me back? Because just because you can doesn't mean you're going to, right? And as far as a mortgage lender is concerned, the worst possible thing that can happen in their world is that they have a client that doesn't pay. What they really want to do is they want to lend you the money and they just want to collect their mortgage payment every month. And at the end of the term, 5 years, 3 years, 2 years, whatever it is, you know, they either renew your mortgage because you've been a good person, or they get their money back and they move on to the next client, okay? They don't want the hassles of foreclosures or power sales or any of that kind of stuff. So they're really looking at, will you pay me back? And the basis for will you pay me back these days is your credit report. When I got my first mortgage, I walked into a bank branch on the corner of Wyndham and Macdonell in Guelph. I met with a lovely assistant branch manager who sat down, asked me a few questions, made a few notes on an application, then walked over to the branch manager's office and came back 5 minutes later and said, "Congratulations, Jeff, you're approved." That was back in the day when, you know, the person who had the decision-making power actually would meet with you face to face. Branch managers no longer have that kind of authority. Everything goes to a person, usually, you know, downtown Toronto in a cubicle somewhere. These days, maybe in COVID, down in their basement. A lot of my underwriters are working in basements now. And the only thing that they see is your credit report. That's the only thing they know about you in terms of the will you pay me back. They're going to look at your credit report and they're going to look at the history on that and the details on it, okay? The final question is that they're going to ask is, what's my security for the loan? In other words, what am I going to do if you don't pay me back? Okay, well, I'm going to sell the property. Is there enough equity in the property that I can get my money back if I have to liquidate it? Okay, and that comes down to the quality of the property and the down payment. So they're going to look at the property. They're also going to look at your down payment. Okay, so those are the 3 major questions that any underwriter who's looking at your application is going to be looking for answers to. I sort of look at the mortgage process as like a court case, right? Me being the lawyer, the underwriter at the lender being the judge, okay? So the application form that we fill out, maybe you do it online, we do it on the phone. Most of mine are done on the phone these days. That's kind of the summary of the case that I'm presenting as to why you should get a mortgage. And then we have to prove everything that we put on that application. So that's the supporting evidence. So that's the income documentation, the down payment documentation, and your credit report, okay? And I'm going through this because this becomes super, super important when we're doing a pre-approval, that you understand that, you know, income documentation, down payment documentation, and your credit report are going to be the basis of how the decision is going to be made. We can put anything we want on the application. All the lender's going to do is say, great, prove it, right? the application, I mean, it does have my lovely, notes that I write, my story that I tell about them, but ultimately a big part of the decision making is going to come down to that supporting evidence. And then they're going to look at the property, the appraisal, and the MLS listing. Okay, now we'll talk about appraisals a little bit in a few minutes, okay? So I'm going to walk you through the process of how that I have to do the calculations, and also obviously the lender is going to do the same calculations. Okay, so I like to talk about.
Sorry, yep. Jeff. Do you mind if I just jump in here and ask you a quick question?
Sure.
So, thanks very much for kind of walking through what those kind of few details are that really that you need to gather in order to evaluate someone's application. One of the questions that we got for people that are kind of putting all of those pieces together is, okay, well, how long is that process going to take me? And so if I'm putting together an application in order to get my credit report, in order to get my down payment documentation, how long do you typically like to budget for that process?
So that is entirely dependent on how fast that the client can move. Okay. Literally, I can put together a complete mortgage application on the phone with a client in 15 minutes. Okay. As long as the client knows what their SIN number is and doesn't have to spend 20 minutes looking for their wallet, right? And they can give me, the basics, right? So the application basically contains, your name, your address, your phone number, your social insurance number, your date of birth, 3 years worth of employment history, 3 years worth of where you've lived, a list of your assets. Okay, so savings, investments, cars, dogs, cats if they're worth anything. But I haven't seen a lender that's willing to take a dog or a cat. So like literally 15 minutes on the phone.
Okay.
So that's my normal process. Or sometimes I'll send someone a link to my online application. They can fill it out. That shouldn't take them any more than 10 minutes. And then we send out a credit bureau consent form that they sign electronically. We pull their credit bureau. Might take me 15 minutes to review the credit bureau. May have to get on the phone with the client to ask a couple questions. And then we send out through our system a list of documents that we need.
Okay.
If the client happens, if depending on what the client's situation is, if we need tax documents, T4s, NOAs, that type of stuff, we can send them out another form to sign, and I will literally have a complete 2-year tax package from a service provider that we work with at Dominion Lending that can go into the Revenue Canada system and get all that information for us. So I could literally have somebody pre-approved in 24 hours if they have.
If they come prepared and they're ready to move.
Yeah. Now, it doesn't make any sense for somebody to run off and go and get a letter of employment today if they're not planning on, doing anything, for 6 months or 8 months, because that letter of employment will be stale dated. So that's part of the conversation that we have. Here's the documents that I'm going to need. I need this now, this now, this now. That one I don't need for, until you're ready, type of thing. Okay.
Okay. And
so,
I'll just jump in here. We did get a question from Diego, and Diego, thanks very much for that. We are, I'll encourage everyone that if you have questions as we go forward, please feel free to either jot them down on a piece of paper or throw them into the chat or the Q&A, and we will we'll definitely make sure to take those up at the end. So,
no, because you don't want to break my rhythm, man. I mean, come on.
I mean, I already felt bad interrupting you once, but.
All right. So the question number one, can you pay? So basically the way that works is there's a formula to it, okay? And I call it the magic number one, which is GDS, which stands for gross debt service ratio. So basically the lender is required to, figure out what your debts are compared to your income, okay? So the first calculation that we're going to do is we're going to take the proposed mortgage payment monthly take the property taxes monthly, okay? If it's a condo, we use 50% of the condo fees. And then we have to, don't ask me why we have to do this, but we have to add in some factor for heat. So that's usually based on square footage. Most of the time it's $100, right? We just put in $100. And the Government of Canada, the Ministry of Financial Institutions, and all the powers that be have told us and mandated that those four things should not be more than 39% of your income, okay? So this is the starting point. So just as an example, so if we had $5,000 monthly income, so you're making 60 grand a year, that means that your mortgage payment plus your property taxes plus 50% of the condo fees plus the heat cannot be greater than $1,950 a month, okay? So that's magic number one, okay? So we take $1,950 a month, we subtract out all the property tax, all that stuff, and we work backwards and we come up with a maximum mortgage amount based on that, okay? Then we have magic number, so this is our example here, right? So we've got our 1950 that we just calculated. Let's say our property taxes are 300, our condo fees are 50% of our condo fees are 150. Our heat is $100. So we subtract those off. That means that your maximum mortgage payment can't be any more than $1,400 a month, okay? And then we just work backwards and basically figure out how big of a mortgage that is. That $1,400 a month is what we call a stress tested payment, okay? And I'll go through what the stress test is in a few minutes, but we have to calculate it based on the government's stress test rules. Then we have our magic number two, which is our total debt service ratio. That takes into consideration all the things we talked about before: mortgage payment, property taxes, condo fees, heat, and any other debts that you have, okay? So car payments, student loans, outstanding balances on credit cards, lease payments for any cars that you might have, anything like that. Not the rent that you're currently paying, not the insurance that you're going to pay on the house or anything like that, just strictly debts. Basically, the rule of thumb is if it shows up on your credit bureau, it's got to get added to the file, okay? So we take our $5,000 a month income again, and then we subtract all those things, okay? And then we do, that total cannot be more than 44% of your income, okay? And when I say income, I'm talking about income that is before tax, okay? So no deductions or anything like that. So if you're on a $50,000 a year salary, we're working off of $50,000. So with our example, that's gonna come to $2,200 a month, okay? So all those things cannot be more than $2,200 a month. The government in all their wisdom has figured out that that's the maximum that people can afford to pay and still be able to live, okay? I might disagree with them, but I don't get to set the rules, all right? So doing our calculations, if we had our $300 property taxes, our condo fees, our heat, and let's say you had a car loan for $500 and you owed $5,000 on your credit card, credit cards and lines of credit, we'd have to take 3% of the outstanding balance. So 5 grand, that would be 150 bucks, okay? We add that into the calculation, and then we subtract all of that off of the 2,200. Now we're down to a mortgage payment of $1,000 a month, okay? Stress tested. So you can see that, you know, the debts that you're carrying, if you have big car payments or you have big outstanding balances on your credit card, they can significantly drop the maximum mortgage payment that you're allowed to carry. I mean, we went from $1,400 a month just by adding in, you know, $650 a month worth of additional debt. We're now down to $1,000 bucks, okay? So it's really important that, you know, you take a look at your situation and, you know, work with someone like myself to do the math and do the calculations and figure out, you know, maybe you have to adjust your priorities for a short period of time. Instead of saving for a down payment, maybe, you know, working on getting your debt down to an acceptable level. And the acceptable level is basically your monthly payment shouldn't exceed more than 5% of your monthly income, okay? As soon as it goes over 5% of your monthly income, it starts to lower the amount of your maximum mortgage that you can get, okay? So the stress test is something that's been handed to us by the federal government. They did it about 5 years ago, 2016, I think it was. And basically what they've said to us is that in order to qualify somebody for a mortgage, you, me, mortgage broker, and lenders, okay, any federally regulated lender, okay, so that pretty much covers off about 95% of all lenders in Canada. They have to use an interest rate when they do those calculations that we talked about before of 4.79%, spread out over a maximum of 25 years or 30 years in some circumstances. You're going to hear the in some circumstances a lot tonight because nothing is 100% clear cut in the mortgage industry, okay? So 4.79 over 25 years. This is a bit laughable as far as I'm concerned, because right now, if you came to me for a mortgage, 5% down, like you'd be looking at an interest rate of 1.5, 1.4%. But we have to calculate your qualifying payment at 4.79. Just before COVID, the government had decided that they were going to change the stress test, and it was going to be super advantageous for buyers, because it was going to be based on the prevailing rates as opposed to this fixed mythical rate of 4.79%. But when COVID hit and everybody in our industry got super scared about what was going to happen and whether people were going to be able to, afford their mortgages because they're losing their jobs, and whether house prices were going to collapse and everything else, the government abandoned that plan and stuck with the 4.79. In the meantime, interest rates have dropped through the floor, and honestly, that stress test should be more like 3% or 3.5%, not 4.79%. But I don't set the rules, so we got to work with what we have right now. Okay.
And Jeff, how often do they adjust that number?
Since they started it, we've seen it go up and we've seen it go down, and I would say that it probably is averaged about once every 6 months.
Okay.
Okay. And I expect that, there's a lot of fear, still in the marketplace because of new COVID variants and stuff like that. But I would suspect that the Ministry of Financial Institutions is going to be looking at that, sometime in the near future, and hopefully, bringing it down to reality. Because I honestly think that we're in this low rate environment for, at least a couple years. So, and I think that's the general consensus. So it doesn't make any sense to be stress testing stuff at 4.79. All right, so back to the will you pay question. So we talked about, your credit report and your credit history. So the first thing I'm going to say to everybody is get on your computer, cancel your Credit Karma account, ditch Borrowwell, never go back to your bank's website and look at your credit score there, because they don't mean squat in our business. There are two different credit reporting agencies, generally speaking, in Canada. And there are probably half a dozen different algorithms used to calculate credit scores. The one that mortgage lenders use almost exclusively is this FICO score, okay? And FICO stands for the Fair Isaac Corporation, which is a US company that developed this algorithm, and FICO has licensed it to Equifax. Equifax is the only company in Canada that can provide a FICO score. Your Credit Karma is not a FICO score. Your Borrowwell is not a FICO score. Part of that licensing agreement with Equifax is that Equifax is not allowed to share the FICO score with the general public. So even your bank, which has access to your FICO score, is not allowed to give it to you, okay? So the only way to get your actual FICO score is to have a bank or a mortgage broker actually pull your credit score, okay? And it is different, and I've seen, I just had a file where the client said to me, oh yeah, I went on my CIBC, and got my credit score, and we're both in the 650s, we should be great now. And then I pulled their Equifax, and she was a 581 and he was a 610, right? So they went from being excited about their credit scores to like, oh crap, we still can't fix our mortgage problems, right? So Equifax FICO score is king. The only way you're going to get that is by having somebody in the financial industry that does mortgages actually look at it, okay?
And
the other thing that I'm going to say is,
sorry, Jeff, just on that comparable, because I know that, I'll take full ownership over it. Every time I log into my RBC app, it's like, hey, you want to check out your credit score? And I'm like, oh yeah, sure, why not? Let me see how good, or maybe like how scared I should be. But what causes that difference between the Equifax FICO score and like why the difference, and what?
It's the mathematical formula.
Okay.
Like honestly, so Fair Isaac Corporation in the U.S. has been at this for like 60 years or something, and they have developed a mathematical formula, an algorithm that is considered to be the most accurate predictor of whether or not a person is going to pay and whether or not the lender is going to end up having a problem. Okay. And that just, it's just accepted by the industry as the Mercedes-Benz of credit scores. And that's just the way it is.
Gotcha.
Everybody uses it. We do have some lenders that will accept a TransUnion credit report, but what I will tell you is that every single one of those lenders is also going to pull your Equifax report.
Okay.
Last year, TransUnion was giving us credit reports for free, so a lot of us pulled a lot of TransUnion reports, but then some of those files got tripped up because the lender pulled the Equifax, and we ended up with a problem. Okay.
Gotcha.
The other thing that I will say is that credit score is not everything. Okay. The credit report can be 3, 4, 5, 6, 7 pages long. And the underwriter is going to go through that credit report, and he's going to look at it line by line by line. Okay. And there can be things in that credit report that will prevent you from getting a mortgage. And I'll give you a great example. I told Luke this example the other day. So I had a phone call from one of the realtors I work with in a mad panic. He's like, Jeff, a client of mine went to TD Bank, got pre-approved for a mortgage. They sent her on her way with a nice pre-approval certificate. And she went with me, and we went and put an offer in on a property with no conditions. And then she took the offer to her mortgage person at the TD Bank branch. And the person submitted it, and the next day it came back declined. And like, we just don't understand what's going on, because like, she was pre-approved. And so I get her on the phone, I do the application, I pull her credit bureau while she's on the phone, and I quickly scan through it, and right, on page 4 of the credit bureau is a missed mortgage payment on her previous mortgage. Well, missing a mortgage payment in the mortgage industry is like the kiss of death. Okay? No lender wants to touch you if you've missed a mortgage payment unless you've got like a really incredibly amazing story as to why that happened. Because lenders know that people will miss their car payments, their alimony payments, their child support payments, their credit card payments. They'll not. The last thing that they'll miss is their mortgage payments. So that's an immediate indicator to the lender that there was probably some really bad financial management going on there, and they're just not interested, right? I mean, they just don't want all the headaches and hassles of having to deal with someone who's not going to pay their mortgage. So it's super important that, the person that you're dealing with reads that whole credit report and knows what they're doing. I think what happened in that TD Bank branch is that person just looked at the credit score and said, yeah, no problem, you're pre-approved. Here's a certificate, on your way, right? And they screwed up, and that little mistake cost that lady quite a lot of stress. We eventually got her mortgage done, and everything was good. But not without her, probably almost having a heart attack because of the stress of it all. The other thing I will say about credit scores is that in Canada, the interest rate you get is not necessarily determined by your credit score, okay? And of course, I'm going to say some exceptions apply. But for the most part, and I'll explain why just in a little bit, but for the most part, if you qualify, you qualify, and you qualify for best rate. Okay, so you just need to have an acceptable score. You don't need to be a unicorn, which is what we call someone that has a 900 credit score. Okay, and I've only ever seen one unicorn in my life, and they do really exist in the mortgage business. I don't think they exist in real life, but they do exist in the mortgage business. All right, so, and then we're back to the what's my security. So we talked about property value versus the amount of the mortgage, right? That gives the lender comfort. Bigger down payment, the more equity, the happier the lender is, right? Because if they have to liquidate your property and your property is worth $500,000 and the mortgage is only $400,000, they have a $100,000 cushion. They're probably going to be okay. They're not going to lose money, right? However, a lot of you are probably sitting there and saying, yeah, but Jeff, I only got like 5% down. Like, how much comfort does that give the lender? Well, in Canada, we have this beautiful thing called default insurance, okay? And default insurance is the magical thing that allows you to get a mortgage with only 5% down. In fact, we used to do it with 0%, like zero down payment, which was amazing. I used to do a lot of zero down deals. It was a lot of fun. So default insurance, and some of you may have heard the term CMHC insurance, is basically an insurance policy that protects the lender from losses. So as long as the lender has crossed all the T's and dotted all the I's on the application and has, documented everything, done all the anti-money laundering stuff that they need to do for the federal government and everything else, and their file is nice and clean, if the mortgage goes bad and they're facing a loss, the default insurance company will pay. Okay, and that's one of 3 companies: CMHC, Genworth, which is now called Sagan or Sagen, and Canada Guarantee. Okay, and each one of those has slightly different policies, and we'll choose or ask the lender to send it to one or the other, depending on the policies that we need in order to get the deal done. All mortgages where the down payment is less than 20% have to have, by law, default insurance. No mercy whatsoever, unless it's a private lender. Okay, if it's your own money, you can do whatever the heck you want with it, right? If you want to lend somebody 100% of the value of the property, knock yourself out, you can do whatever you want. But if you are federally regulated, which the 99% in the 5%, 10%, under 20% down space, you have to have mortgage default insurance. The borrower pays the default insurance and it gets added onto your mortgage, okay? And that insurance will range from a high of 4% of the amount of the mortgage down to 2.8% of the amount of the mortgage, okay? And it gets added on and you just pay it with your monthly payments. You don't have to actually come up with that money as part of your closing costs. All right, we're getting to the end here. Pre-approvals, myth versus reality, probably the most important part of this entire discussion that we're going to have today. Okay, so I have an app that you should all download and never use. Okay, you should download it. I mean, it's a calculator. It's nice. It works. You can calculate mortgage payments and all that kind of stuff. But part of that app is a 60-second pre-qualification, and you see these 60-second pre-qualifications advertised, on TV. RBC does a thing and everything else. I'm here to tell you that those 60-second pre-qualifications, excuse my language, are total bullshit. Okay, they are not worth the 60 seconds that you're investing in, because there are so many nuances in the income calculations, the down payment calculations, the credit bureaus, all that kind of stuff, that 60-second pre-qualification really does not mean anything whatsoever. What you really, really need is a pre-approval, okay? And there's 2 kinds of pre-approvals. One is a pre-approval that you can count on, and one is a pre-approval that I wouldn't want to see you going out and putting an offer on a house based on that pre-approval. And the difference is how that the pre-approval is done, okay? So the one that you shouldn't count on is, your standard pre-approval that about I'm going to say probably 90% of lenders do. And that is the one where I send in an application electronically. Along with that application, it has your credit score, okay? And it goes through a computer system, and the computer system does the simple, thing. It says, oh, does the calculations that we walked through before, and it says, oh, the GDS is less than 39%. Good, check. The TDS is less than 44%. Check. Move on to the next. Credit score is greater than 620. Pre-approved, right? No human being has looked at the notes that I've written. Nobody has actually reviewed your, job history. Nobody has actually read the credit bureau. Okay, it's just been done by a computer, and that is really all that accomplishes for you. Is it allows the lender will lock in your interest rate for 120 days while you're out shopping for a house. That's really all it is. We just call that simply a rate hold, okay? And 90% of the pre-approvals out there are exactly that, okay? They're being done by a computer system, and you really shouldn't be counting on them. What you want is what we call a fully underwritten pre-approval, which means that an underwriter, the guy who makes the decisions, has actually, looked at your application, has actually read the credit bureau, has actually read my lovely notes that I wrote. Maybe he's even called me and asked me a couple of questions about your file. And then he's made a decision that, yes, I can approve these people for X number of dollars, okay? And then the second decision that he has to make is, if it is a mortgage that's going to require that mortgage default insurance that we just talked about, he's going to make a decision based on his experience. Can I get mortgage default insurance for this particular file? Okay. And that is super, super key, because if your down payment is less than 20%, without that default insurance, you're not getting approved, right? So the underwriter, who we'd like to believe are super experienced, and they do, I don't know how many files a day they do, but I mean, it's massive amount of volume. You'd like them to believe, you'd like to believe that they have a really good sense of, what the mortgage insurers will and will not approve. The problem with the pre-approval process is that we cannot send your mortgage pre-approval application to one of the mortgage insurers, okay? The mortgage insurers will not do pre-approvals. And for the same reason that most lenders will not do fully underwritten pre-approvals, and that's that only about 20% of all pre-approvals ever turn into actual funded mortgages. But yet it costs, an underwriter at a major financial institution is probably making $140,000 a year. So, their time is pretty valuable. And, if they have to do, 20 pre-approvals a day, that starts to add up, very significantly. And that's why most lenders do not like to do fully underwritten pre-approvals. Now, fully underwritten pre-approvals are the only thing that I do, okay? I will not give you a pre-approval certificate from anywhere else other than a lender who has done a fully underwritten pre-approval, because I do not want a phone call, down the road, saying that, we can't get this done. So, I like to go through the complete process with my clients on a pre-approval. We do the application, we pull the credit bureaus, we collect documents, we review the documents, look for any monkey business or anything that we're worried about or whatever. And then when we submit that pre-approval, we write in our notes, hey, Paul, Mr. Underwriter, take a look at my client's, visa from 2 years ago and let me know if that's going to be a problem. Okay. Or, my client has only been on the job for 1.5 years, but they're making a significant amount of overtime, and their overtime this year already exceeds what they made last year. Can we use this year's overtime in addition to last year and average it out, right? So we work with the underwriters that way so that we can make the pre-approvals absolutely as solid as we possibly can. So my advice on pre-approvals is do not accept anything less than a fully underwritten pre-approval, or risk what happened to that client at TD Bank. And
Well, and
that's my warning shot for you.
Yeah. And I think Kim and I were just actually, as we were coming into this, and we've talked about clients that you've worked with in the past, Kim, where they go and they shop for houses and they've got, okay, we've been pre-approved for X, and they go out and they shop around within their budget and they find their dream house and they go, okay, let's put an offer in, and the stars all align and they get the place and everything's wonderful. They go, okay, perfect. We have to submit our offer back then to either our mortgage broker or our lender. And ultimately they don't end up getting the dream house because they haven't gotten the proper pre-approval.
Yeah, and it happens. And the other part about pre-approvals that, I don't want to be, a fire hose, dumping cold water on people's enthusiasm, but the actual approval of your mortgage, as we talked about before, is also based on the property. Okay, so that pre-approval, it's still subject to whatever property that you're trying to buy. Okay, and so that's also part of the process that I use and go through. And I have an advantage over a lot of mortgage brokers because, as both Luke and Kim know, I used to be a realtor. I don't do it anymore because I wasn't very good at it. But you get an understanding of property.
No comment, Jeff.
What's that?
No comment.
Anyway, so I do have a sense of the market and what houses are all about, and so what I always encourage the realtors that I work with when they're going to put in an offer, and inevitably in this market, most of the time the offers are competitive, and you've got a number of people competing, and inevitably I get the phone call from the client or the realtor saying, can we go in without a financing condition? And the first thing I always say is, send me a copy of the MLS so I can take a look at it. And and part of that process of me taking a look at it is using the knowledge that I have about real estate and properties and the things that scare lenders and appraisers, and looking at that MLS listing. I also have access to a automated valuation system that is sort of like an automated appraisal system that will give me a value for that property. It's sometimes difficult for that system to keep up with the pace of the market, but we can always extrapolate and say, okay, I think that's going to be reasonable. So I mean, the pre-approval is fantastic, but recognize that the property also has stuff, something to do with it, and sometimes you just can't. Sometimes the lenders or the insurers just don't like the property. When I was selling real estate, I actually brought in an offer on one of Kim's listings, and my clients had been pre-approved, hard, fully underwritten pre-approval. For $360,000 purchase, and we put in an offer on that house, and because it was out on Highway 6 out in Aberfoyle or Puslinch or whatever that is called there, I think the offer price was like 300 grand, so it was well under what they were pre-approved for, but all three mortgage insurers would not do the deal, and we had to bail out of the deal and get the client's deposit back. And then a week later, they put an offer on a house for $350,000, and it was improved. It was approved in 4 hours. So property has something to do with it as well, right? So that's part of the process that I like to work with, and that's why I kind of selectively choose the realtors that I work with, because I need them to collaborate with me so that we can figure out whether what we're talking about doing in terms of price and whatever is going to be reasonable, and that we're not going to have an issue. And I think
so. Jeff, I was just going to say, I just want to be cognizant of everybody's time as we're
I'm on the last slide, so we're done.
Perfect.
I mean, I could go on for hours, right? But I think at this point, questions is probably drive the direction where you want to go.
All right. So yeah, so just so that everybody knows, we will, if you do need to jump off at 8 o'clock, totally understand that. We did only kind of budget 7 to 8, but Jeff and I did have a conversation before that this topic of financing and mortgages can go on for quite a while. So I will encourage people that if you do want to stick around for a little bit longer, we will make sure to cover everyone's questions. But then ultimately, if we don't get to everyone's questions, this is when you can absolutely book some time with Jeff and have all of your questions answered about mortgages. Because as you can see, I know that Jeff doesn't mind sharing his wisdom, and so I think that we'll try and cover everybody's questions here today. So just so that we kind of go through, there's a couple of questions that I've got, but I just want to make sure that we get to everybody's kind of the questions that people have posed in the Q&A section. So we've got a question from Diego. So Diego, thanks very much for asking your question. And I believe that it was in relation to then when you're touching on mortgage applications, Jeff, and looking at people's work experience and their previous income. And Diego said, what if I have lived or worked abroad in the last 3 years? Do I have to work in Canada for 3 years in a row, or have then income from, I guess, from a company that's based in Canada?
Yeah. So Diego, basically, what the criteria is that if you have permanent full-time employment or even part-time employment with guaranteed hours, that's considered acceptable income, okay? So like I deal with a lot of new to Canada people that would be in the exact same situation as you. They may have only been here for 6 months or a year or whatever. As soon as they have a job that we can get a letter of employment that says that you're permanent, full-time, not on probation, making X number of dollars, we can use the X number of dollars. The challenge with what you're talking about comes when the income is variable. So if we have someone who's working on an hourly basis, then we have to have guaranteed hours. So the job letter has to stipulate how many hours that you're guaranteed. And we wouldn't be able, even if you're working a lot of overtime, we wouldn't be able to use your overtime until there's like a 2-year history of the overtime. Okay. So, but yeah, I mean, absolutely, you don't necessarily have to have like a 3-year history. The lender just really wants to know that, you haven't been, I don't know, like, living under a rock for the last 3 years or whatever, right?
Okay, perfect. Well, thanks for that, Jeff. And Diego, hopefully that answers your question. We had a next question that was in regards to percentage down and also looking at then default insurance. So Jeff, do you suggest putting the entire 20% down and foregoing the extra amount added for the default insurance, or only putting 5 to 10% down and investing the rest at a higher rate than a default insurance
amount? I guess that's going to come down to what your goal is, right? That's more of a financial planning question than it is. The doing 20% down opens up a lot more opportunities in terms of getting to a higher purchase price. We have a lot more programs available that can stretch your purchasing power when the down payment is 20% down. If you can get what you're looking for with only 5% down or 10% down, then it isn't necessarily a stupid thing to go with the 5% or the 10% down. The one advantage of the insured mortgage route is that when a lender has mortgage insurance in place, as long as they have dotted all the I's and crossed all the T's, they have no risk. So therefore, they're willing to offer clients the absolute lowest possible interest rate. So everything as far as interest rates is upside down and backwards in this industry. The guy with 5% down gets the best rate, and the guy with 20% down gets the worst rate. It should be the opposite way, but because of mortgage insurance, it's flipped, okay? So the advantage is that you'd get a much better rate. You do have to pay the mortgage insurance premium, but the mortgage insurance will follow you with that mortgage for the entire 25 years that you're paying it back. So you'll have the benefit of the lower interest rate for the full 25 years. So there's some upside and downside to it.
Okay. Because I think we also had some questions that were, what percentage of your savings should you put towards a down payment? I was wondering what percentage you should put down on a $400,000 house versus a $500,000 house. So I think you answered that question well, but it is kind of up to your comfort level, and then also then what else you are either interested in or taking on from an investment standpoint. So
yeah, exactly. Yeah, and you know, like sometimes we do a little bit of financial engineering with files. You know, we're like, okay, you know, we need to get your purchase price up a little higher. So you've got $50,000 for a down payment. If we take 12,000 of that and pay off your car loan, then now all of a sudden we can get you to a higher level, right? So we may make a few adjustments that way and, you know, pay off some higher interest debt, or unfortunately in some cases it's 0% interest debt, but debt is debt as far as the lender's concerned. They don't care whether it's 0%. They don't care whether it's one of these credit cards where you're not making payments on. They're going to add that 3% onto your thing. So, you know, sometimes we just have to move the numbers around a little bit to make it work.
Yeah. No, and I thought that you made an interesting point earlier when you were talking about that, and you may look at someone's portfolio and you may assess that, okay, maybe it isn't necessarily saving towards a larger down payment that you need to be focused on within the next couple of years. It actually should be locating or reallocating funds to paying off other debt before you then start saving up to.
Yeah, exactly. And that's, you know, that's something that I do, you know, virtually every day with clients. You know, I look at this as a long game, right? It's not you know, I take your call today, I want the application in my system 15 minutes from now. And, you know, like sometimes, you know, it takes 2 years for a client to be ready to buy, right?
Yeah. Okay. We had another question that was from Jack Lamkin. And Jack, I believe that this question has to do with the pre-approval process. And it was, does this process change when working with a builder where the closing date is a year
out? It becomes, so it doesn't really change, because almost all builders these days are asking for a pre-approval letter from a financial institution before they're willing to proceed, right? So, I mean, we basically have to go through the same process, and we have to do it on the basis of your situation today, not your situation, you know, 5 years from now or 6 months from now. Or I have a condo client has a condo being built in Burlington that doesn't close for 3 years, right? Like doing a pre-approval on that to me seems silly, you know, because so many things in her life could change. But, you know, the reality of it is you got to do it. So yeah, we go through the same process. You know, sometimes honestly, we play around with the numbers a little bit. Like if you don't have all the money saved up for a down payment, you know, the lender's not going to ask for your documents at that point in time, because they don't want to review them at that point when you were talking about something that's not going to close for a year, because they know that so many things can change, right? The one thing you do have to be aware of is, you know, if you're doing a new build, you have to be, you know, very cognizant of changes in your financial situation, right? Like you cannot have any adverse changes in your financial situation. Don't go off and, you know, buy $10,000 worth of furniture at, you know, Tepperman's or Leon's or whatever on a do not pay for 9 years program, because that's going to show up on your credit bureau and the lender is going to pull your credit right before closing, and that could pooch the deal. And I'll tell you right now, it wouldn't be the first one that I've seen where all of a sudden we've got a problem, you know, a month before closing, because the client has gone off and done something silly or changed jobs or whatever, right?
Yeah. So like you said, whether it is a new build project or whether it's a new condo building or anything that's going to have a future move-in date, it is still a snapshot of where you are at now. And you need to pretty much keep that kind of consistent all the way up until you're moving.
Yeah. Like make it better if you can, but you know, don't do anything to make it worse. And you know, and I always I'll have that conversation with the client, and there's actually a pre-written email that, you know, I send to the client, and it's, you know, kind of the warning shot over the bow of the boat that says, like, here are the things you are not to do between now and closing, because otherwise, you know, we're going to be scrambling to try and fix it, right?
Yeah.
And Jeff, the only other thing is, you know, with working with builders now, some of the closings aren't till 2022, 2023. there's no way you can have a rate hold. So you've got to be flexible with the rates and how they might change.
Exactly. Yeah. I mean, we have programs that will stretch the rate hold out for like a year, but if you're talking about a condo that's going to be built 2 years from now or 3 years from now, like you're not getting a locked in rate for that. There's no way. So I mean, your rate, you got to be prepared that your rate may be significantly higher than what it is today, and budget accordingly.
Yeah. Well, Jack left us a comment there saying, very helpful, Jeff. Thank you. Yeah, we were looking at late 2022 right now. So no, that was, no, that's good. The next question we have was, and this one will be for you, Jeff. Who bears the cost of a mortgage broker? Is there any direct costs associated to the home buyers?
99% of the time I get paid by the lender, which is good for you guys. You get all the free advice that you can stomach, and I get paid by the lender. As a rule, I do not choose my lenders based on how much they pay. I choose my lenders based on the ones that are the best for the client, and we will, as part of the approval process, we have a conversation about what the options are, and that. The 1% of the time where I have to charge a client a fee is generally, if they require private financing, or they've got some very unique situation. Like, I did a mortgage for a guy a couple months ago who was unemployed, right? And he was locked into buying this house. He had a firm agreement of purchase and sale, and no job. And so we had to do that with a private lender, and I had to charge him a 2% fee to cover off my time. But that's literally 1% of the time. I'm going to guess that most of the people that are on this webinar are going to be in the 99% category, where they will never have to pay me. They're welcome to pay me if they want. I accept gift certificates. LCBO is always good. Golf Town's good. But I get paid by the lender.
Okay. The next question we have is, how do you compare mortgage options/terms? Can you go for multiple pre-approvals from different institutions, or does that end up hurting your credit score from doing multiple credit checks?
Well, so first of all, the way the system works is I pull your credit bureau and I send that same credit file to however many lenders that I feel your file needs to go to. So there's literally only one pull of the credit bureau. So it doesn't affect your credit score. And the way that the system, the credit bureau system or scoring system is set up is that there's a 45-day window for, like, the algorithm is smart enough to realize that, you may be shopping for a mortgage. And so you may go to TD Bank, and you may go to Scotiabank, and you may go to a mortgage broker, and that may result in 3 pulls on your credit bureau. If those all happen within 45 days, there's no hit on your credit score.
Okay.
Okay. If you're doing that with cars, just so you know, the window is 10 days, right? So if you go to 2 or 3 car dealers and they all pull your credit, if it's all within a 10-day window, there's no hit. If it's outside of 10-day window, it starts to affect your credit score.
Okay. No, that's a very good point. Now we have a little bit more of a, I guess, more of a.
Luke, can I just say one other thing regarding that question?
Sure.
So understand this, that when I send in your application for a pre-approval, we are by no means locked into that lender, okay? If when you finally find the house that you're gonna buy and you get an accepted offer, and I look at my system and I'm like, well, that, First National pre-approval, that rate is crap, but I can send it over to, Scotia, or I can send it over to XMC or whatever, and get the client a much better mortgage. That's what we're gonna do, right? And that's why only 20% of all pre-approvals ever fund, because people, they shop around at the last minute, right, when it comes time for an approval. So the pre-approval doesn't lock us in, but what the pre-approval does is give us comfort that you're going to get approved, right?
Okay, gotcha. Okay, the next question we had was, as someone with very good credit, a large down payment, so 20% or more, what are the benefits of going to a mortgage broker versus a bank? And is there a large difference in rates?
How much time do you have?
And
So
this is one of those times when we could say that, and I get that this is a specific question for someone's specific scenario. So this might be a one-on-one conversation with you.
Yeah, but let me just briefly say it this way, right? So I'm not anti-bank by any stretch of the imagination. In fact, our number one lender at Dominion Lending is a company called First National. They are literally the best mortgage lender in the business. They're number one for a reason. Our number two is Scotia. Okay, so and then I think TD Bank is probably lands at about 4 or maybe 5. We choose the lender based on what's best for the client, and we'll have a discussion about the advantages and the disadvantages of going with a bank versus a non-bank lender. The mortgage landscape in Canada is made up of banks, credit unions, non-bank lenders like First National and Merrick's, and we have all kinds of different lenders. And in most cases, depending on individual circumstances, there is a compelling case for why you shouldn't have your mortgage at a bank. And then in some cases, there's a compelling reason to have your mortgage at a bank. I'm not biased one way or the other. I just believe that we try to fit the client with the best possible product for them. And that's part of the whole discussion that we have.
Yeah. And I think that's to your point of the example that you gave when you're shopping for tires for your car, right? It's, you can walk into one brand and they're only going to sell you that one brand of tire, but it's understanding, okay, they may not be the best or they may not be the best tire for your car. And so you need to kind of look at the spectrum of what's out there and really look at the age stage of your car. What model is it? What are you going to be using it for? All of those different scenarios, and go, okay, what's the best tire that's on the market?
Exactly. And part of our process is we'd like to have a conversation with the client about the future, right? Like, what are your plans? Mm-hmm. Is this your first house, your last house? Is there a chance that you're going to move out of province or out of country? Is there, a chance that you're going to inherit some money? Or all of those questions come to bear on the answer as to whether getting your mortgage from a bank or getting your mortgage from a non-bank lender is the right way to go, right?
Okay. The next question we have was, how much does the down payment vary the mortgage? Does trying to save more in advance, so not living paycheck after paycheck on mortgage payments?
Well, having lived at one point in my life many moons ago, paycheck to paycheck, because my mortgage was so humongous, I don't highly recommend it. But you do what you got to do in order to get into the market, right? And I think my advice generally at this stage in the market cycle that we're in to clients is that the sooner that you can get into the market, the better off you're going to be, because prices are rising faster than people's incomes are. So as each month goes by, your affordability is getting eroded, right? So the quicker that you can get yourself set up to own a piece of real estate, the better off you're going to be. And if that means that you have to do your mortgage with 5% down, my recommendation is do it with 5% down. Do it sooner than later, because if I look at my client base and I look at their financial statements, their applications, and I look at where their wealth comes from, like the vast majority of the client wealth that I see comes from owning real estate. So the sooner you can buy, in my opinion, the better off you will be.
And it was interesting in the first session, Paul, we were having a very similar conversation about, looking at the market is continuing to increase and income levels may not be following at the same rate. And Paul had an interesting point about, to a first-time buyer, he said, a lot of people are showing up going, okay, so what are you looking for in a house? And they start describing the house that they grew up in and not necessarily the house that they should be starting off with. And so
Yeah.
an interesting conversation about setting expectations of, okay,
Exactly.
yes, you may want to aspire to be in this house, in the house that you grew up in, but we need to, just to get your foot in the door, like you mentioned, setting kind of your expectations on, okay, this is going to be your first house. It's not necessarily going to be the last house you ever buy, but it's at least getting your foot in the door and starting to grow from there.
Yeah. Yeah. I mean, to your point, my first house was 480 square feet. Seriously. And I owned it for 4 years and I made a killing on it.
Yeah.
Right. I mean, living in 480 square feet was not fun. Right. I mean, it really wasn't. But you know, it was a great lot, and we made some good money on it, and sold it, and bought another one, and made some good money on that, and sold it, and bought, and we just kept on going, right? And
you could have almost reached, like, if you forgot something in the kitchen, you could just like reach over there. If you needed to go into your bedroom, you could reach just over the other arm and grab it.
That was pretty much it. The truth be told, when my daughter was born, my firstborn, her crib was in the laundry room. Because we only had one bedroom, and it wasn't big enough for a queen size bed in a crib.
Yeah. So guess who got kicked out of the bedroom?
I slept on the couch for a while.
Yeah. So the next question we have was is about first-time home buyer incentive, and so do first-time home buyer incentives still exist? Is going the route for default insurance common for a first-time home buyer due to the lesser down payment?
It's mandatory. Like if your down payment is less than 20%, then there's no way around it. The mortgage has to be insured, and the borrower pays. There's no ifs, ands, or buts about it. There is not one single lender in the country that is going to pick up the tab for your mortgage insurance. The first-time home buyers incentive program, I got to be honest, I'm not a fan. And the reason why I'm not a fan is because you're making the federal government a partner in the ownership of your house. And why I say that is that the way that program is structured is, if you're buying a resale, they'll give you 5% of the purchase price for a down payment. And you've got to pay them back. And the way you pay them back is when you sell the house, you give them back the 5% that they gave you, but you also have to give them 5% of the increase in value of the house. Yeah. So the example I like to use is, I had this gentleman, his name was Muhammad, and he was very fiery Middle Eastern guy. And he came to me, and he needed to get a mortgage, and I got him a mortgage. He didn't really qualify for a mortgage, but I got him a mortgage, and the interest rate was very high, and there were some fees attached to it, and he had to pay me a brokerage fee, and he was really angry about having to pay me a brokerage fee, and he was not too excited about the fees. But he got his house, and then 11 months later he called me and he said, "Jeff, I just sold my house." I'm like, "Oh, that's interesting." I said, "How much did you sell it for?" And he started laughing. He said, "I sold it for $141,000 more than I paid for it." And I said to him, I said, "Muhammad, are you still pissed at me about the fees?" and he basically laughed. He says, "No, my friend," he says, "I want you to do it again for me." Right? So, you know, I mean, in that example, if he had used the first-time homebuyers incentive program, you know, he would have got, it was a $440,000 house, so the government would have given him 22 grand, and he would have had to give them the 22 grand back plus $7,000, which would have been the share of the government's increase in value, right? Yeah. So $7,000 on a $22,000 investment, I'll take in 1 year. I'll take that all day long, right? I mean, that is a massive interest rate that the government charged him, would have charged him on that money, right? Yeah. So I'm not a big fan of that program, and I think the truth of it is the government, when they brought it out, they were expecting to do billions and billions of dollars worth of these mortgages, right? They're effectively a second mortgage. And the last time I looked, it was like $150 million or something, right? Like nobody, you know, and all it does is increase your purchasing power by that small amount, that 5%, right? It's not like it makes the difference between you buying something and not buying something.
Okay. Now, I know that we got a lot of questions about the that incentive. So no, that's really great insight. Yeah, so if anybody has any more questions, please feel free to throw them in the chat or throw them in the Q&A box. Those were all really great. While we wait for a couple of questions, there's one more that just jumped in here. When talking about your net income for the GDS calculation, is that household income for a couple or each individual person?
Household income. So basically, anybody that's going to be on the mortgage application, we take the gross income.
Okay, perfect.
Now, if we're using your income, then you, as a rule, have to be a co-owner of the house. So if you're getting your parent, for example, to co-sign because you can't qualify for what you want, generally speaking, that parent is going to have to be a co-owner on the property. The lawyer can title that as the parent owning 1% and you owning 99%, so that they avoid the tax implications and you still get the land transfer tax credit and all that kind of stuff. But as a rule, if we're relying on a person's income, they have to be a co-owner of the property.
Perfect. Well, thanks very much for that. And yeah, we'll give it, we got another question. Must be a follow-up question. If one partner hasn't had a steady income for more than 1 year, would it still be wise for the mortgage to be in both names?
I would say that is kind of a game time decision. Like, I'd have to see the application and I'd have to see what that partner is doing. Like, if they have, part-time hours that are not guaranteed, then, we can still put them on the application and make them a co-owner of the property, but the lender is not going to, they're not going to take that person's income into consideration in the calculations.
Okay.
Lenders like guarantees, right? They like guaranteed hours. They like salaries. They like, they love self-employed people, but, you have to have generally speaking, you have to have a 2-year history, although we do have some programs with, 1-year history of self-employment that we can make work.
Okay. So I just want to be cognizant of everybody's time here as we get to 8:21. And I think as some of the further questions were coming in, they are starting to get a little bit more specific to people's situation, which is fantastic. And that's exactly really what we were hoping to accomplish out of this webinar, is that this is going to act as an introduction into these topics and really start to kind of prepare yourself for, okay, so what are the next steps? And this is where we then, hopefully you've gotten a little bit of a taste and a little bit of an education into about what Jeff and the mortgage business is about, and then how you can start preparing yourself best right now. But following that, again, I know that Jeff would love to book some one-on-one time with people and be able to hear some of those questions. So in a follow-up email, I will make sure to send not only this recording for everybody, but I will also make sure to attach Jeff's contact information so that you can ask some of those further questions and you can book some time with him. So,
and I've said this to you before, Luke, and I say this to all my clients. Like, when my goal is that when we're finished the mortgage process, that you walk out of my office, if you were allowed to come to my office, but you're not. So, and you're not coming to my basement, which is where I am right now. But when we're done, my goal is that there is no question left unanswered. You should walk out of the process being 100% comfortable about everything that you've agreed to, and that, no question is a dumb question. So, I am always happy, if you want to call me or, email me or text message me with your questions, by all means, just do that. And I'm happy to have the conversation because, I've always believed that information is the most important thing that we as mortgage brokers do, is helping people make good decisions, right? And you can't make good decisions if you have unanswered questions.
So I guess I'll just kind of wrap it up, and Jeff, just kind of ask you one final question. So like we kind of touched on at the beginning, there's maybe 2 groups of people that are walking away from this going, okay, this is the year that I'm going to buy a home, and I really need to get started on all of this. Like you said, being kind of prepared as they can be to start their application process. But at the other side of it, for those people who are looking then 2 years, 3 years, 5 years down the road and wondering, okay, what can I be doing now? What would then your kind of final takeaway message be to both of those groups? And what do you hope they walk away from today?
Well, if you're thinking about buying now, then my advice is get in touch with, a mortgage broker and start the process. Even if you're not going to be buying for 6 months or whatever, start the process now. Simple things like credit bureaus, okay? I can't tell you how many times a year that I find mistakes on people's credit bureaus, right? Unpaid, like things that show up as unpaid collections that were paid off years ago, credit cards that the client doesn't have, or closed 2 years ago or whatever. If you start the process now, get the information that you need now, have your credit file reviewed now, you can, even if you're not going to buy 6 months from now, you can at least be comfortable that you've got a game plan. You've got to have a game plan. I mean, buying a house these days is like a war, right? And you have to be prepared for battle. And, from a financial point of view, your best preparation is to get that process started as quickly as possible, and, fix anything that needs to be fixed, or, just get prepared, right? If you're not planning on buying for 2 years, I still think that, there's always value in having a conversation. It doesn't make a lot of sense to go through the whole application process, but this is where the 60-second pre-qualification comes in, right? Except my version is not 60 seconds because I like to talk a lot. So, it's going to be a 15-minute conversation. But you know what? Like, have a 15-minute conversation with someone who knows what they're talking about, and figure out, make sure that you've got a game plan, right?
Yeah.
And maybe that's not a game plan that you're going to execute on in 2 years, but make sure you've got a game plan so that you're not arriving 2 years from now worse prepared than you are today, right? And I mean, this is what we do on a daily basis. I mean, most of what we do is provide advice to people.
Yeah. Awesome. Well, I think that is a pretty good place to wrap it up. So I will say, Jeff, thank you on behalf of everyone for taking the time today and sharing your information. It's really, I know I said this at the beginning, this was one of the most kind of requested and talked about sessions and topics. So hopefully, no, you really shared a lot of insights with us. So thanks very much for joining us. And like I said, I will send everyone, Jeff, your information. So I know that you'll be looking forward to having your inbox blow up over the next few days.
Well, glad to be here. And, I love what I do. So I always like to talk about mortgages, right? So, it's, so like I say, anybody, you want to have a conversation, just reach out.
Awesome. And so that will kind of bring us to the end of session number 2. Like I mentioned, next week on Thursday, now that we've kind of walked you through, you understand a little bit more about what's going on in the market. You've now kind of got your head, hopefully, kind of introduced and wrapped around to the idea of how important it is to get your financing and mortgage in place. Next week, we're going to be talking about when you do come prepared with your financing in place and you're ready to start shopping for a home, what that process looks like and what the offer process looks like and everything that you need to be aware of going into that. So it should be a really good episode. And before we log off, I do have another door prize that is here, and it is a $25 gift card to Bread Bar, which does have locations here in Guelph and also in Hamilton, I believe, 2 locations there. So I've got the wheel of names here pulled up on a window. I will click enter on that, and we'll see who the lucky winner is. So congratulations to Erica Zen. You have won the $25 gift card. So we will make sure to that you get a hold of that. So thanks very much, everyone, for tuning in. I know that we went a little bit longer than expected, but yeah, hopefully then you pulled a lot of value out of today. So thanks very much for tuning in, and we'll hopefully see you all next week.
Bye, everybody.